There's sort of four main things I really like to cover, and then obviously we'll talk a little bit more about sort of how investors should be thinking about sort of their portfolio allocations this year. The first, obviously, is the fact that number one, growth this year is on a recovery path, right? Although for a lot of us, it may not necessarily feel like that right now. But I think one of the things we need to definitely realize is that we are at the beginning stages of a new economic cycle. The recession is kind of over, and we are right now still at the bottom of the economic sort of recovery curve, but we're definitely trending towards that recovery stage. So the way we should be thinking about investing in our portfolios in 2021 is, what should we do at the beginning of a recovery? What sectors will do better? What markets will do better? And what currency exposures we should manage within our portfolio? A lot of this obviously depends on the rollout of the vaccine. As if anybody thinks 2020 was the year of the virus, 2021 is definitely the year of the vaccine. Yeah, so a lot of things we're seeing right now, obviously, is contingent on many different things going right this year. Markets tend to be priced to perfection at the moment. And if you can see on the left-hand side chart there, what I've done is I've just pulled up a couple of really big sort of stock indices around the world. You have the S&P, you've got Europe, topics is Japan, and CSI 300 is China. And what you can see right now is markets really have been pricing in a lot of the good news that we saw coming out of November, December last year around sort of different types of vaccines and different things rolling out. So one of the things we need to be mindful of for a lot of investors right now is that nothing necessarily cheap. So one of the things we really advocate for a lot of investors this year is to basically broaden out your exposures and be diversified. Don't be too clever trying to find one specific exposure that you think will do really, really well. Make sure your exposures are diversified. And one of the reasons why a lot of investors are so positive is if you look at the graph on the right-hand side, right now, as I mentioned, we are in the early stages of a recovery. China is a bit of an anomaly because unlike other markets in the world right now, they managed to reach their pre-COVID GDP levels before the end of last year. First in, first out. But if you look at the US, you look at Japan, you look at the Eurozone on the right-hand side chart there, we are still working our way out of the hole, right? For a lot of countries around the world right now, we are still in repair mode, but we are definitely in recovery mode. And our forecast over the next couple of years is that over time, probably by 22 or 23, we'll definitely reach pre-COVID levels again, but don't expect it to be like an overnight sensation. So if we go to the next page, I think these are the sort of the four main points I really want to cover. I touch a little bit on sort of the global growth recovery and the vaccine rollout. I'll have a couple more slides to show you guys on this in just a second. The second thing I want to discuss, obviously, is our view on equities. Obviously, I know the profile of a lot of investors on this call are very sort of equity centric. I want to touch a little bit on sort of where we see the drivers for equities coming in 2021. The third is this notion that a lot of investors have been bringing up, is that emerging markets in Asia Pacific should do better than the US this year. And maybe I'll touch on a little bit on nuances in that particular regard. And the last thing, obviously, is this idea of value versus growth. Value being sort of cheaper stocks versus growth having sort of stronger earnings momentum. Obviously, where we're seeing right now is that value may make a comeback within the first half of this year as investors are looking for other opportunities to grow their portfolios. So if we go to the next page, this really just highlights the optimism that we're seeing in the market right now. And I think just building on what I was saying earlier is, if you look at the graph on the left, that pretty much shows you the breakdown of GDPs on those sort of four large economies that I sort of mentioned just right now. You can see obviously Q2 last year, the world took a massive hit, but then rebounded so sharp and so significantly on the back of so much stimulus around the world, whether that be sort of central bank stimulus, government stimulus, and we're seeing that play out going forward. And you can see that reflected again on a more sort of forward-looking metric, which is one of the metrics that we use, which is the Purchasing Managers Index. And this is effectively a survey that's done for a lot of industrial companies around the world, asking them how their book orders are, what are their inventories level like, how optimistic they are around the world right now. And you can see the massive recovery just purely on sentiment for a lot of the industrial sectors around the world. Just again, reinforcing this point that a lot of people are getting more and more optimistic about global growth recoveries. But again, on the next page, you'll see that this kind of hinges on one key thing, which is basically the vaccine rollout. Now, I think the video that I think everyone was listening to just right now sort of like talked a little bit about it, but this is going to be the main make or break moment that's going to dictate where global growth or the pace of global growth is 2021 onwards. So we're seeing some countries around the world now inoculating their citizens much, much faster, but obviously different types of vaccines, different sort of treatment or efficacy levels. And obviously we touched a little bit on the storage concerns right now, keeping things in cold storage. So a lot of different moving parts, a lot of factors right now. So again, this is again one of the things that we need to be mindful of. Markets have priced everything in such optimistic terms that any negative news could give us a lot of volatility. So it's going to be a good year for risk assets, we think, but at the same time, any negative news or any just sort of missed expectations could definitely impact the market and have a lot of volatility. So again, we're really advocating for a lot of investors to not put all your eggs in one basket, be diversified. I'll touch a little bit on the next slide on the US situation, because I know we just passed the inauguration. We've got, I don't want to, and I think we had a little bit of a play on words here. It's not necessarily a blue wave that we got in the US, given the really tight sort of lead that the Democrats have in Congress. We're calling it a blue ripple. Now, one of the things we're definitely going to expect from the Biden administration this year going forwards, obviously, pandemic is the priority, right? They need to tackle this. They need to tackle it hard, because while other countries are in their second, third, and fourth waves, the US is still in their first wave, and they've never really addressed it. But hopefully this resolves sooner rather than later. And then the next actual main priority for the administration really is going to be building infrastructure and focusing on sustainability within the US. So I'll give you a really interesting statistic. If you go back the last 50 years, there hasn't been a brand new airport built in the US at all over the last 5 decades. Whereas if you look at China, that number is more like over 80 airports being built. If anybody's flown to the US and gone to JFK, you would have noticed that the roads leading into New York City itself could basically be mistaken for something in Tanzania, for example. Right. So one of the main priorities for for the administration this year really is to focus a lot more on sustainability. So again, this is really re-emphasizing our focus on some of the really key, interesting sort of like innovative sectors. We're talking about renewables, we're talking about batteries, we're talking about anything to do with sort of low carbon or carbon transition. Now, let's pivot and talk a little bit about equities, because obviously one of the big focus points on the next page is for a lot of investors is what are equities going to do this year? So one of the things I wanted to maybe point everybody's attention to is if you think about, if you want to break down equity returns, right, there are really sort of 4 main drivers of equity returns. The first one, and I've color coded it on this page, it makes it a little bit easier. So the first one we always got to think about is, and this is the most important one, is earnings growth. So that's EPS growth out in the green part. If you're not buying equities on the back of earnings, then you shouldn't be buying equities at all. The second is dividend yield. That's in the blue. The gray is multiple expansion. That's just sort of like the price changes, right? That's just sort of, again, you can expect the PE moves primarily. And on the fourth one, you have currency return. Again, we are global investors, so currency obviously does play a role. It'll add or detract to your portfolio, so you got to get some of your calls right. Now, what happened in 2020? 2020 was a year of purely nothing but multiple expansion, right? Obviously, we had no earnings last year because we were in a recession. But what happened last year, as price shot up, earnings were negative. So obviously your multiple will be significantly higher. But what's interesting is that this is the year in 2021 that we expect earnings recovery to continue. And we really do expect basically that a lot of the equity returns this year will be driven by earnings. So we need to make sure that the companies we're buying right now have robust balance sheets, wide moat levels of cash, and basically have sort of a really interesting profile that can basically support the valuations. And again, this is actually quite mirrored. So if you look back at the last financial crisis back in 09 and 10, what happened in the first year after the crash? You had nothing but multiple expansions. And you can see that in that sort of bar chart for 2009. And earnings was negative. What happened in 2010 was you had the reversal, right? Because obviously as earnings recovered, the valuation, the PE actually comes down. So as earnings continue to recover, stock will not look as expensive as they are today. So valuation at the moment, not necessarily a good metric for gauging whether or not you should go in and out of the stock, because everything will look expensive because price moved, but earnings went the other way. So one of the things to bear in mind is earnings recovery this year, and you can look at that on the next page actually, it's going to be the biggest support for equities this year. So you need to make sure that the companies you're owning in your portfolio or the funds or whatever you guys buy has really robust earnings growth. And this is going to be the thing holding it up. And as I mentioned, a lot of things are priced for perfection right now. But the one thing that will help dampen volatility is to make sure you own quality, not just growth, but quality growth as well. So again, this just shows you the sort of consensus earnings growth over the next year and 2022. Again, for broadly all markets, we're pretty positive on earnings growth this year because we're coming out of a very deep hole. A bunch of that is attributed to base effect as well, but bear in mind, this is a very positive profile. And again, the trajectory is really important. Next page just really talks about sort of less geopolitical volatility, I suppose. Now that we have sort of a blue administration, we are expecting more predictability with US-China relations. We don't expect things to go back to normal. We don't expect tariffs to be rolled back. We don't expect anything to really change materially from what has already been done. But the path of communication should be a little bit easier. Now, the US-China relationship has fundamentally changed, right? So I think the US has finally woken up to the fact that they, in about 5 years' time, will no longer be the number one economy in the world. That'll definitely be China. So they're trying their best to basically slow down that growth from China's perspective and reassert their dominance on the global floor. So one of the things we want to bear in mind right now is don't assume that the US and China are gonna basically go back to 5 years ago, for example. You're going to see continued parallel development of new technologies, new policies. So as investors, this is quite interesting because we can basically tap into sort of both growth channels right now. So again, let's say we just talk about something like 5G. There's not going to be one company doing 5G and implement around the world. China will do its own thing, US will do its own thing, and the rest of us around the world will basically have the opportunity to basically pick and choose what's best. So actually, for consumers, for investors, actually it ends up being a much better thing. So don't let that freak you out. And the last point I want to sort of bring up is this idea around value versus growth on the next page. So what's been happening over the last several years is that value as a style, so we're talking about buying value stocks and hoping that will appreciate as markets realize their intrinsic value, for example, right? This as a style has been underperforming for years, right? And you can see that on either of these charts, right? What happened last year around November time when they announced the vaccines was that we had a reversal of this. So value had outperformed growth as a style. So basically company like, for example, ASEAN as a region did really, really well in November time. I think the region did something close to 20% within the month of November alone, right? Primarily on the back of this reversal. Now, one of the things to bear in mind is that we expect this growth value reversal dynamic to continue in the first half of this year, but it probably will not be a sustained phenomenon because we expect, again, for growth and quality growth to end up being the longer term structural driver. So value as a style, we think has legs, but maybe won't finish the marathon. So the next page just concludes everything I just mentioned just right now. We are quite bullish this year, but we do expect a lot of volatility. So a lot of investors need to maybe buckle up and be diversified. We do like credits compared to government bonds. Within equities, we do have a preference for higher yielding names within emerging markets. We do like Asian names and ASEAN for that sort of cyclical recovery. But we also want to have exposures to really interesting sectors like disruptors, innovators, and really new and structural thematic ideas in the portfolio.